And 3, 2, 1. Welcome to the show. What's up, buddy?
Welcome to the show. All right.
One of these days you're going to be back here permanently, but you keep escaping.
This is a nice place to escape to up here, my friend. As you know, you've been in the undisclosed
I'm just
location.
jealous, honestly. I'm stuck down here in Northern Virginia. You're up there in Happy Hole.
Well, you're getting ready for doing a little exercise for a big trip coming up. So,
yeah, man. Me and my brother are walking the Grand Canyon.
That is
slowly.
Cool.
Very
It
slowly.
was on my bucket list, but I think once I turned like 52, I kind of ticked that one. Not ticked it off because I did it. It fell off.
Yeah, it was never on my bucket list at all. But it was his bucket list. So I was like, all right, I've talked people in enough stupid crap in my life. I can do it. you've been witness or party to most of them. Hey Jerry, you want to go run 400 miles? It was 300 some miles, whatever. Yeah, all right, man. What do you got for us this week?
All right. Yeah, we got a lot of stuff to go over on the show, but there's two things I wanted to talk about before we get to that. Probably a lot of people have seen there's a Fed Week article that came out that kind of did the updates to the Federal Retirement Thrift Investment Board meeting that happened this week. It's a monthly meeting. Anybody from the public can dial into it. All you got to do is go to FRITB, whatever it is, Federal Thrift Retirement Investment Board.gov, and there's a link there that will take you to the call. So I was on it this week, and it was a big mea culpa from Accenture Federal Services, right? So they were the prime. They're responsible for the integration. A-Light was the sub. They're giving us access to the mutual fund window. That's all good. AFS, Accenture Federal Services, gets on the call, and they were apologizing for primarily the help desk. They talked a lot about how things are getting better. Call wait times are decreasing. Everything's getting better with the help desk. They didn't address anything like, hey, I did a rollover 2 months ago and my money's not in my Fidelity account.
And I still don't have my money.
Right. Right. They didn't hit any of those.
I don't understand. I mean, all the complaints were about the help desk, but it wasn't just the help desk. It was the fact that the help desk is not helping.
Right. Right. Well, see, here's the bottom. Here's the thing. I went to Accenture Federal Services website. Okay. And if you hit the tab that says their capabilities, all right. So their capabilities are Accenture Federal Studio, which is kind of the software that you would do things in, artificial intelligence, digital government innovation, cyber resilience, and federal IT modernization. Okay. So I have some other notes, but the bottom line to all this, we needed a financial services capabilities like Schwab or Fidelity, right?
And what we got, that wasn't on that list, was it?
No. What we got was a tried and true federal integrator, right? I mean, Accenture's, there's nothing wrong with them. They know what they're doing. They were just way outside of their lane, right? And I completely see how this got to where it is.
Yeah, none of the subs A-Light, I guess. A-Light is a financial services company, right?
Yes. Well, yes. Yeah, they're just the ones that gave us access. Right. They're not really a financial services company.
They're not like Fidelity or TD Ameritrade or.
Right. What we needed was the ability, was the functionality that the public interface gets with TD or Schwab or Fidelity.
Right.
And we did not contract for that. We contracted with an IT integrator. And so that's why we are in the boat we're in. That's my explanation, and I'm sticking to it.
Did they let you jump on the call?
They let me listen.
Yeah.
We needed a square peg for a square hole, and we got a round peg. You know what I mean? It's pretty much that simple.
I mean, isn't it though? I mean, we're kind of sidetracking a little, but it is like, you and I both were in the government for 30 years, and that's oddly enough, it's not surprising that they did that, because how many times have we seen that happen where, they knew it was clear what they wanted to do, but they just didn't get the right people to do it. They hired good people. Right. They contracted with good companies. It just wasn't the right company to do this. And you expected them to do it, and no, it didn't happen.
I mean, who knows who bid on this contract? I mean, who knows exactly what the RFP looked like?
Right.
Like all that, right? But at the end of the day, when they stepped back and looked at what they were actually getting, either they didn't understand what Accenture actually is able to provide. I mean, Accenture, they want the contract, they bid on it, they were able to meet the requirements, and they bid on it and they won. It could have been Raytheon or Boeing or anybody else, as far as that goes. But we needed a Schwab or a Fidelity,
right?
And we didn't get it.
We could have hired
all right.
Grow Investments.
Yeah, right.
We could have screwed it up for them just as much as they did.
I don't think we could have made it any worse.
Right, that's what I'm saying. I'm not saying we would have done it better. We wouldn't have done it worse.
Ironically, right, we were just setting up that 401k for our company, and it was very simple to go through there, and we were doing the back end. We were doing the things that
because we hired a company that does 401ks. We didn't hire one that did integration. Right. We didn't hire a media company to figure our 401k out.
Right.
Yeah.
All right. I don't want to beat it up too much, but I really think that's.
By the way, if you want to come work for Grow Investments, we have a 401k now.
We do.
We got a pretty good money manager too.
I would tend to think so.
You're biased.
And we do not have a 25% limit on how much we can contribute to the mutual fund window, and we can do ETFs and stocks and anything we want.
We use Thinkorswim on our 401k. Actually, I mean, it's crazy what you're able. I mean, it's our company, so we can choose whatever 401k provider we want. But Jerry and I've been consulting and doing other things, and I've worked with companies that had these things, and so I've seen the other side, not just the TSP, right? And so, even my girlfriend, like everybody I know that has a 401k, is frustrated because of the similar kind of rules you have in the TSP. But the thing is you don't have to have that. Your company actually could get a 401k that has all those restrictions off of it, and they just don't know any better. I mean, Jerry and I just set up this 401k for our company. Of course, it's just us, but now we can use TD Ameritrade, Thinkorswim, which is a monster platform that you can do anything with. We can use that to trade anything, ETFs, short in the S&P 500, whatever, right? And no limits to that, right? And so why other companies don't take the gloves off for their employees and let them grow? Well, anyway, they don't. Yeah. But I'm just telling you guys, if you're listening, that it is possible. Like it's not that they can't do it. It almost goes back to they're hiring the wrong thing, right? They're just going with whatever company they think they should go with, and they probably don't even ask the questions. Like, Jerry did the due diligence by finding a company that allowed us to have, it's called a brokerage window, right? It's like what the TSP has with the mutual funds. It's a window into another system that allows us to use our 401k money to trade into that window. And it's a perfect example that I would imagine A-Light did not put any of those restrictions in the mutual fund window. Right. It was us that did us, the government. The government did it, right?
Yeah, 100%. It was out before this thing kicked off. I can't remember where I read it. Some article was talking about there wasn't going to be restrictions. A-Light wasn't going to put any restrictions on it. It was only the government's restrictions.
Yeah. All right. Enough about all that stuff.
Let's
jump into the show.
I got one more. I got one more thing before the show.
No.
Where September is in like 3 days, right? Thursday, I think, is September 1st. Mm-hmm. Okay. So here we're something interesting. So seasonality, right? We've talked about seasonality quite a bit. Historically, September is by far the worst month of the year for stocks, historically, back to 1897. Okay. The average loss in September is 1.13%. That's compared to the average gain of 0.77% across every other month in the remaining 11 months. Okay. And that's back to 1897. No one seems to know why this phenomenon exists, but there's a really good article out this week on MarketWatch. We talk about it in the article. Talk about it in the email that we put out with the newsletter. So if you're on our email list, you'll get that. But it's a really interesting article. And so just kind of as a heads up, September historically is, by far, not even close to any of the other 11 months in the year. So something to keep in the back of your mind.
Well, thanks for that good news, Jerry.
It's just, it doesn't mean the market can't go up in September. It's just news. I'm just reporting the news. All right. Weekly update show 28 August 2022. So We've had some requests about doing technical indicators, and how do you do both daily and weekly? Like how do we kind of integrate those two? And I'm going to go over that with examples, basically with the S&P 500. And I'm going to use my three favorite indicators, which is the simple moving average line, relative strength indicator, and the MACD moving convergence divergence indicator, whatever. It's a long name. And then we're going to take a look at Apple because it was quite a week for Apple, and then the TSP fund charts. Okay, so technical indicators, right? Why do we even use them? Technical indicators offer a different perspective from which to analyze price action, right? Some, such as moving averages, are derived from simple formulas, and the mechanics are actually very easy to understand. Others, like stochastics, have more complex formulas, and we don't really, for our purposes, need to get into the definition and the math and how it works. We really don't know. We really don't need to know. So regardless,
we do know. We just don't need to know.
We know. We just don't need to. It doesn't. You don't see all the math, obviously, in the chart behind it. So technical indicators can provide a unique perspective on the strength and direction of the underlying price action, and that's what we want to know. We want to be on the right side of the market, and the way you do that is to know the strength and direction of the underlying market. So cause when it flips, you want to know it, and that gets reflected in price. So basically, we want to know three things, right? We want to be alerted when something changes, and we want to confirm the position that we're in. And ideally, we want to be able to see a little bit into the future to have an idea of which way we expect the market to go, and then respond when the market goes that way. So an indicator can act as an alert, right? If momentum is waning, meaning there are fewer people buying into the stock or the index or whatever, it's probably a signal to watch that if price is continuing to go up as momentum is going down, price is getting ready to roll over, right? It's divergence. We've talked about it quite a bit. Indicators can be used to confirm other technical analysis tools. So it's kind of the opposite of divergence, right? You would expect momentum to be moving higher as price moves higher. That's a positive. It's confirming that trend. So according to some investors and traders, indicators can be used to predict the direction of future prices. That's where most people kind of find themselves, I think. And I certainly use them as a direction, but and it creates an expectation, but I'm not making reallocation decisions until the expectation is confirmed. Okay, so moving averages, right? A simple moving average is an indicator that calculates the average price of a security over a specified number of periods. So all that is, right? We use the 20-week moving average quite a bit, right? That's what we always put up on the last charts whenever we do the show. All that is you take the closing price over the last 20 weeks and average it. And then each week you go forward, it drops off the previous, the first of that 20-week series and adds the next one, and you do the average. So it smooths out the price movement, right? That's all it's for. It's just designed to smooth it out, and you can see the trend instead of getting hung up on, the daily or weekly movements, whichever you're looking at. You can see the smoothed out trend. Okay. So the question basically was that got me to do this was, how do we use this both in terms of weekly and daily? Okay. So if you're looking at the S&P 500 and you're trying to decide if you're going to invest in it, you want to see where the long-term trend is, and which is you do on a weekly chart, and then you're going to whittle it down to a daily chart. If you're going to trade only on a weekly basis, you're going to use the weekly chart, and then you might pull it out to a monthly before that, right? So it's patterns within patterns. So here we're looking at the blue line is the 50-week moving average, okay? The red line is the 200-week moving average. And we can get a lot of information from it, okay? There's a term that's called the golden cross, okay? That's when the 50-week moving average crosses up through the 200-week moving average, okay? Or it can be on a daily, right? You could say the golden cross on a daily chart is when the 50-day moving average crosses up through the 200-day moving average. But if you're looking at it from a weekly perspective, when the 50-day crosses up through the 200-day, yes, you didn't get this gain here, but it made the odds of a continued rally much more likely. So you do get this whole gain here, right? On the downside, it's a death cross. Okay, when the 50-day crosses down through the 200-day, bad things are happening, right? So it's a long-term trend indicator. So when it crosses up, it's not like it never goes back down, but the overall trend, the 50-week has been above the 200-week since 2011. So the long-term trend is up, and it still is. Even with all this volatility we have going on here, it still is. And this is where things get concerning as you watch it, because up here at the top in 2022, we were way, on a percentage basis, like way above that 200-week moving average. So to get back down to support down here was a huge move down. And then hopefully at some point, as the market continues down, we do get support at that 200-week moving average. Okay, so that's how you kind of use it in a big picture. The other thing to look at is most of the time on a weekly basis, price finds support at that 50-week moving average line, right? It rides that 50-week moving average line for most of the time periods, okay? When it closes below it, it tends to come down to that 200-week moving average line and get support there, right? We had a big overshoot at COVID, but most of the time it comes down and finds support at that line. So it's a good place, if you're in the G fund and the market's crashing. A good example of that is actually 2018, because we're going to see this section in the next chart. Price had found support at that 50-week moving average line all the way along, and then broke that line. And then if you looked at it and said, okay, we're below the 50-week moving average line, how low is price likely to go? And if you know that the 200-week moving average line is down here, you have some kind of expectation of how low price can go, right? So then if we flip to this is a 5-year daily, okay? And this is where we were, what we're just talking about right here. So price broke down below that, in this case, 50 and 200-day moving average, right? Because now we're on a daily. And if you're wondering how low can price go here, at the end of 2018, you can expect to find support at the 200-week moving average, which was right there, which is where it did get support, right? So that's kind of how you're integrating the daily and the weekly charts. Does that make sense?
It does to me.
Okay, good. Yeah, and so if you're trading more frequently, right, this is a 5-year daily chart. So again, once the 50-day crosses up through the 200-day, we have this long bull run, right? Once we have the death cross, the interesting thing about the death cross is it tends to identify a short-term bottom, but a longer-term down move. So a lot of times when you get that death cross on whatever day you're on, it tends to be a near-term bottom in the market, but then only to come up and roll over worse. So there's a lot of little nuances in there. It pays to kind of really look at this stuff and not just take what you hear on YouTube for fact. Okay. All right. So that's how we would use the moving average lines. And at the end of the day, what you're really trying to do, like, there's nothing special about the 200-day moving average or the 50-day moving average. What you want to find, and it changes over time. It changes based on the market conditions, but you want to find moving averages that represent support levels. Okay, if we had a 10-day moving average here, it wouldn't do us any good because the price goes up and down through that 10-day moving average line so much that it doesn't do us any good. It's not useful, especially for us where we get closing day prices and you have to have your trade in by noon, and you only get 2 moves a month. So
Yeah, I think it's
50-day and
important
the
though
200-day.
yeah, to know that like people ask us every once in a while, like, well, how did you come up with the 50-day or the 200-day? I mean, we didn't really come up with it. It's just a normal option in most charting software because those are generally kind of the best sweet spots, right?
Right, right. That's all everybody's trying to do is find moving average lines that represent ongoing support levels.
Mm-hmm.
That's or resistance levels. That's what you want to
Yeah,
know.
I mean, you can definitely use different ones and tinker with it and see what works for you. But at the end of the day, 10-day, 50-day, 200-day, these are going to be normal options because they kind of hit that sweet spot. But that doesn't mean that they're the only ones you can use. And this is generally, how I trade with what I would call semi passive investing, right? Things that I'm not going to be looking at every day. I'm in for the long haul, and I want to know that I'm on the right side of the trend. So I only need to look at this once a week.
Yep. Right.
And I think that's a huge takeaway for people to understand, right? You don't have to look at it every day. As a matter of fact, if you follow our site, if you're a member of our site, what we recommend is that you read the analysis that Jerry puts out once a week and make your decisions for the upcoming week. That's it.
Yep. Especially if you have any money in the mutual fund window.
Yeah.
You don't want. I mean, it costs $28.50 each time you trade, and so ideally, you're getting into a fund that you're not. You're gonna draw maybe a 200-day moving average or even a 100-day. If it depends, you're still trying to find the moving average line that provides support, but you don't want to be in and out in the mutual fund window either.
Right.
Okay. So the second one is relative strength. So it's developed by Wells Wilder. It's a momentum oscillator that measures the speed and change of price movement. Okay. So it's an oscillator. So it oscillates between 0 and 100. It's considered overbought when it's above 70 and oversold below 30. We talked about this before. It can be generated by looking for divergences, failure swings, centerline crossovers, and it's used to identify the general trend. So we talk about it all the time as that center line, that 50 line on the RSI. It's in this case, this is what they call a centerline crossover. If it fails to get support at that center line, that's when price tends to go much lower. And the angle that RSI moves up or down is consistent with the idea of speed and change of price movement, right? That's what you're trying to identify, is how strong is the momentum in one direction or the other. So if it's just trickling, if the indicator is just kind of trickling up, there's not a whole lot of speed, and power behind the price movement. So the trend isn't super strong. If it goes up or down, with a lot of a strong angle one way or the other, there's a lot of power behind that move. So again, this is the same 20-week, same moving average line chart, but we just added the RSI down here. So when we get below 30, it's oversold, right? Some things to point out here. Let me see. So here's a pretty good one. Price came down here in 2010, okay, and it got to this level in RSI. Comes up, gets back overbought, price is higher. Price comes down and it puts in a higher low here, but a lower low in RSI, right? So basically it's not going to go much lower here in RSI, but it's got a higher price. So it's a divergence, right? Divergences are one of the big things that we're looking at here. A really good one is here in 2015-16. So price comes down, RSI gets down here close to oversold, but not really. In 2016, price is lower, but the RSI is higher at that low, right? So we have a positive divergence. So we're expecting price to break out to the upside from that divergence. It's one of my favorite things to look at. It's what I was really, really looking at in the short term this week. We're not going to do a daily chart, but this week on the S&P, it was last Tuesday, so almost 2 weeks ago, the S&P hit a high for this rally that started in June, and then we had a pullback right late last week. And I was looking for another move higher, but RSI not to confirm that move higher, and that would have been the most likely place that the market would have rolled over. We didn't get that. We didn't get that extra move higher. It just completely collapsed on Friday. But that's how you would use the RSI in coordination with the price chart. So on a 5-year, again, we're back to a 5-year daily chart. So we get the 50-day, the 200-day, and RSI on a 5-year daily. So same kind of prices moving higher, but RSI is trending lower, right? So it's signifying a concern. In this case, we top out in 2022. We put in a lower high here, right? We have overbought on RSI here, but we have a lower high here, which is consistent, right? Because it's a high, a lower high, a high, and a lower high. So there's no divergence there. So that's being in line with the trend, which in this case is down, right? So divergence is a huge thing, and these center line crossovers are really big. So why are the center line crossovers so big? When RSI is above 50, the price is moving higher. When RSI gets below 50, price is moving lower. So when RSI finds support at 50, it's a little bit of a correction. You got support at the 50-day moving average, and price kept moving higher. So that's why the crossovers are so important. If you can get support there, that's a good buy the dip place, right? If you don't get support, like here, not so good. Okay, so that's how you use relative strength. MACD, moving average convergence divergence oscillator. As difficult as the name is, it's one of the simplest, most effective momentum indicators available. So MACD turns two trend following indicators, right? Moving averages, which is what we did first, into a momentum oscillator by subtracting the lower moving average from the shorter one, right? You don't have to worry about the math, but it's a trend following and a momentum indicator. Fluctuates above and below the zero line as the moving averages converge, cross, and then diverge. So traders can look for signal line crossovers, center line crossovers, divergences that generate signals. Because the MACD is unbounded, it's not particularly useful for identifying overbought and oversold. So that means that, like on the relative strength, they're saying it's overbought at 70 and oversold at 30. MACD doesn't have those bounds. So it's not as useful. If the MACD is weighed down, it looks like it should be, and then rolls up, it looks like it should be a good indicator that the market's at a bottom, but it's not bounded, so it's not that kind of an indicator. But it definitely helps us. So you got when the black line crosses down through the red line, okay, the momentum is decreasing, all right, and price comes down. When the black line crosses up through the red line, momentum is going up and price goes up. Okay, it's pretty much that simple. That's why we've shown like our stack a whole bunch of times. We got price up here, then we have relative strength, then I have another indicator called CCI, and then I have MACD. And when all those things line up, as on the positive side, it's our buy signal. When they all line up to the downside, it's our sell signal. So all you're doing is stacking these indicators on top of each other. Okay. The other part of the MACD is histogram. So the blue behind the lines is really useful. When there's a crossover right there, especially from a deep, a significant low in the histogram or a significant high, when there's a crossover, it tends to move pretty significantly in the other direction. As opposed to this, like this is basically non-confirming for quite a while, and you can see it because the price is moving up and down, generally up, but it's moving up and down, and it's really, really hard to trade in that environment. So you kind of let it, you just let it play out along the overall trend, which in this case, you're getting support at the 50-day moving average line, or it's weekly, so 50-week moving average line. But this was a good indicator back here when MACD crossed positive and the histogram got above 0. That's right at that breakout of the rally that we had in June. So it's a MACD tends to be a good leading indicator when momentum starts shifting. So back here, we had several weeks of churning at the bottom, and while that churning is going on, the histogram is rising. Okay, and then once we had a price breakout, MACD crosses, histogram goes positive, and it's the time to get back into the stock funds. Based on just the MACD indicator, right? Like I said, we stack indicators on top of each other to get confirmation. Okay. All right. Conan, you get any questions for the group would have about those 3 indicators?
No, actually, I tried to stay quiet because, one of the things we're doing a lot more is we're chopping the show up and doing some small clips, and I didn't want to be talking over you.
Okay.
But I tell you, man, I think we could do 15 different videos on just what you just described and describing it different ways, and because it's so useful. If there's anything that folks that watch this show, if they could take away, if you just learn those things that Jerry just showed you, it will take your investing knowledge to a whole nother level. It just will. Yeah. Right? Because you can use those simple indicators and this isn't just Jerry that's doing this, right? It's not like
I didn't make it up.
You're right. I mean, you're a smart guy, but you didn't create these things, right? And it's what people use who know what to do, right? These are the indicators people use, particularly with the type of investing that we're doing, which is we're doing active portfolio management, but we're not day trading. Right? I mean, we're not. And so if you're day trading, you really have to drill down into a lot of this stuff, and it gets a little more complicated. But, we don't recommend that. I mean, it's a long game, but looking at this stuff once a week will change your life as it comes to investing.
Yeah, 100%. I mean, if you're not using charts and some of these basic technical indicators, I don't know how you're keeping your mind around the news.
Yeah, you're not. You're just working off fear and greed, and that's it, right? Mostly fear.
Yeah. Okay, so speaking of fear and greed, it was a rough week for Apple, certainly at the end of the week, and that's going to be the bonus chart. So we're going to try to pull all the things that we were talking about with the technical indicators into this as we kind of do a quick analysis of Apple. Okay. If we had the top here in April and the top in May, and we connect those 2 lines, right, we get the trend line. So what we're initially looking for is resistance at that trend line, right? But rather than resistance and the market rolling over, price got above both the 20-day moving average line and above that downtrend line. Okay, so that's very bullish if you're just looking at price. At the same time, RSI got above 50, and the MACD, which we said is usually a leading indicator on the upside, had already turned positive. Okay, so that for me was a buy signal for Apple. Okay, so Apple progresses along, stays above its 20-day moving average line, right, and then comes down at the beginning of the week and hits it, and looks like it's getting support, right? So I'm looking at this chart, and I'm going, okay. In terms of Elliott wave count, we got 1, 2, 3, 4, and I'm looking for a 5, which would be consistent with hitting the prior high, right? So I'm looking for Apple to get up to like 180, 185, something like that, and maybe roll over there, or ideally push forward and higher. So in terms of the Elliott wave count, right, of a 1, 2, 3, 4, when you want to see on the 4 leg, price comes down, finds support, and you want to see RSI staying above that 50 line, right? So MACD had crossed over negative, which makes sense because price came down quite a bit. But MACD isn't too negative at this point. And then on Thursday, we found support on like Monday, and then Tuesday was an up day at support. And then this was Wednesday, and Thursday we had a gap up and a big move higher. Okay. So it looked like we were getting that fifth leg up in Apple. And then what happens on Friday? Right? Monster move down. So these things don't always work. It's not an exact science. But what it tells you is, if we go back to this one, if you had bought Apple on the breakout, which I did, right? I bought Apple on Thursday because of this support at that 20-day moving average line and the gap up. I bought it at like 169.50. And then, so I'm expecting Apple to go up here. But what do I know? I'm going to sell it if it gets below that 20-day moving average line, right? So we can't do this in TSP because we don't have sell stops, but they're mental sell stops is kind of how you should look at it in TSP. So, because if this was a chart of the S&P 500 and it broke out on Thursday, and you said, well, I want to get back into it, your mental stop would be below that 20-day moving average line. And so it wouldn't have looked very good in TSP because you would have bought it on Thursday and then sold it on Friday. But you can see by the close, and it wasn't even the close, it was 3:38 in the afternoon. Apple had actually moved lower in the last half hour, but we're below 50 RSI and below the center line on CCI. So I sold it actually on Friday. I want to say 165.10, something like that. So it wasn't a good trade for me, but it is good. It's not good in terms of making money on Apple on that trade. It's good for this move, right? It wasn't good for coming down and finding support and buying more of it again. But it also kept me from losing as Apple continues lower, which it's likely to do along with the rest of the market. Okay. So hopefully that gives you guys an idea of how you use this stuff with individual stocks as well as TSP funds, because it's all the same. All right. TSP fund charts. Same chart that we talk about at the end of every show. Once price gets above that 20-week moving average line, RSI gets above 50, MACD heads cross positive. The odds are that the market continues higher, right? There's no guarantees, but the odds are definitely in your favor when all these things line up, okay? And we had a really good bull run from the bottom of COVID, right? After the bottom of COVID, when we get above that level, we have some corrections, of course, but we come down and find support all the way along at that 20-week moving average line until January. And ever since then, we had a bit of an overshoot here, a little overshoot here. But for the most part, that 20-week moving average line is acting as resistance, and price is not able to stay above it. Last week, we were talking about how last week was a down week. But as long as it's still above that 20-week moving average line, there's still a possibility the price moves higher. This week, it took out all the gains from the past 1 to 2.5 weeks and closed below that 20-week moving average line. And RSI is below 50, and the histogram you can see is starting to turn over and go negative. So not good news for the C fund. S fund, same kind of thing. This was the first time the S fund actually got above, on a weekly basis, above that 20-week moving average line since all the way back here in end of 2021. So this, I was pretty optimistic about this, but it immediately rolled back over. So definitely bearish price action. I fund, pretty classic, rolls over here, can't get above it, can't get above it. It's hitting resistance at that 20-week moving average line all the way down. Do we definitely go to new lows, right? No, nothing's for sure. But that's certainly the pattern and the trend. RSI is below 50. MACD is, had turned positive, but now it's turning back over and start going down. There's just no reason to be in the I fund, really to be in any of these funds on a weekly basis at this point. F fund, same kind of thing. F fund is a little bit different, but Obviously collapses down through that 20-week moving average line. Was way below it, for the first half of the year. We had a pretty good rally off that June low, got above it for a couple of weeks, and then last week was the beginning of the end again for the F fund. There's a lot of arguments out there in the financial news world about if the stock funds do completely collapse, the F fund is likely to move, at least in the short term, much higher from here. So I would be watching the F fund as it comes down. You can see the F fund actually reversed this week. There was a reversal as opposed to the S fund, or the I fund finished at the bottom of the week's moving average line. S fund finished at the bottom of the range for the week, and C fund right at the bottom of the candle for the week. So there's different sort of forces that are at play in the F fund than there are in the other stock funds. Okay.
Questions?
That's about all I got. I would say one thing though. It is a lot. This is, so we had a 50% move higher from the June low to the high a couple of weeks ago, right? That's a pretty good retracement from, so of all the losses that we sustained from the top in January to the bottom in June, we recovered about half of those losses through, it'll be 2 weeks ago on Tuesday. So through about 2 weeks ago. The bottom line is if you're looking to get out of the stock funds and hold on to those gains that you've made since the June low, now is the time to do it.
Yeah.
Is it possible? Is it probable? Well, is it possible that the market rolls over, does some kind of double bottom, and then, or some other bottoming pattern keeps moving higher? Yes, it's possible.
It's just highly unlikely.
I'll tell you two little stats from where we closed on Friday down to test the prior low on the S&P 500 is an 11% move to the downside. Okay. In the S fund, it's a 14% move. So a new leg in the bear market rally isn't confirmed until we break down through those June lows.
Right.
But to get there, it's 11% and 14%.
And nobody wants to take that hit.
I sure don't.
Yeah, we're out. I mean, we are. So we're going to watch it. We're going to keep our eyes on it. If you have any questions about as we went through this video, if you have any questions, put them in the comment section wherever you find the video. If there isn't a comment section wherever you find it, then, hit us up with an email, support@growmytsp.com. If it's something personally relating to your circumstances, we might not be able to get into that because we don't do financial advice over email. But otherwise, shoot us a question. I mean, the topic for today's video came from customer requests, viewer requests is what I meant to say. People asking, hey, can you go into these? And we've touched on these topics before, but we like to revisit them, and a lot of people were requesting it. So that just shows you that we listen to the comments, right? We listen to the questions. So if you have them, shoot them our way. If you like the show, share it with your friends. If you don't, share it with your friends anyway.
Share it with them too.
All right, man. I think we are done here.
Sounds good.
I'm going to go hit the motorcycle because it's nice outside.
Awesome.
All right. See you, buddy.
I'm helping my dad with a little party. Here we go.
Boom.